Welcome to Big Business This Week. I'm JD Durkin here on the trading floor of the New York Stock Exchange. Another busy week of big business here on Wall Street. Earnings season officially kicking off. Bitcoin hitting fresh all-time highs, and Apple making a big investment right here in the USA. Who better to join us now to help us unpack a wild week that has been, and probably more than a few wild weeks still to come. Caleb Silver, editor-in-chief at Investopedia. Caleb, thank you as always. I want to get your sense here on the Trump tariffs, some of the macro picture that we're all sort of contending with in the markets. August 1st, is this the next real, maybe kind of start date for the trade war? And what does that timeline look like for you that you think investors are paying attention to as well?
Yeah, maybe kind of, sort of, we really don't know. And it's just, this week's been like 3 weeks packed into one with all the news that we've had. But that is the number the date we're circling on our calendars, because that's the date that all these tariffs are supposed to go into effect, or we're going to get intense negotiations between now and then that may carry past August 1st. If we learn anything from this administration, actual dates don't really matter, and actual promises and policies don't really matter until they actually matter. And I think investors have looked way beyond that by now, right? They're looking at earnings. They're looking at earnings 6 months out, 12 months out. They're hearing from the biggest companies in the world that they're continuing to spend, continuing to build, and they're also hearing that we're continuing to spend as consumers. The retail sales numbers were pretty good. Inflation was relatively tame. We didn't get inflation in the big things we thought we would, like autos and apparel. So I think that's what investors are focused on. That's why we have yet another all-time high.
Yeah, we did have a CPI print in the last few days, and obviously, Caleb, as you know, there's been an ongoing debate about whether Trump's trade strategy is going to, at some point, push inflation higher. Where do you sort of sit as that evolving debate continues? Are you in the camp that says maybe we need one more month worth of inflation data? Let's see what July has in case so many corporations tried to get ahead of those imports in Q1? Or are we maybe more in territory where we say, all right, we've had a few months worth of prints. It's safe to say we did not really have that price shock many people were worried about.
Yeah, well, it's been more smoke than fire because we really haven't had the price shock we thought we would have, but I have to wait until September 1st to see what happens in the month of August, or the September CPI report to see what happened in the month of August to really figure that out. PPI, producer price index, is relatively tame, so you know the costs aren't coming through yet, and maybe a lot of that's because of pre-ordering. We certainly saw it in the auto sector. Auto sector had a great March and April because everybody thought there would be auto tariffs, that were going to impact sales, so that brought a lot of that purchase forward. We haven't seen it in other parts of in other industries right now. We really haven't seen it in other sectors. I got to wait until literally mid-September to make a call on whether the inflation's come through or not. And even if it has, how much of it is actually being passed on to us as consumers? Walmart said that they would, but so far no one's really done that.
Are individual investors maintaining their composure throughout all of this chaos?
Yeah, and we've been surveying them every 2 months, really going back about 5 years right now. But in our latest sentiment surveys, they're saying we're cautiously optimistic. They feel better than they did a couple of months ago when there was a lot of uncertainty. And individual investors are a lot more optimistic than institutional investors. If you look at the global fund manager surveys, they come out every month or so, they're still pretty pessimistic and pulling money out of the market, even though the markets keep rising to record highs. So where is the money coming from that's taking it to record highs? A lot of it coming from contributions from individuals and retail investors, and a lot of it kind of stuck in these mega cap tech stocks. So I think individual investors are like, I can't fight the trend, and the trend is up and to the right, no matter what we hear out of Washington, D.C.
Yeah, our friends who are chartists are always fond of saying the trend is your friend, which is always worth remembering. Your state on the labor market, I wonder. Obviously, we do get fresh bits of employment data every few weeks. Your sense on how strong the labor market is, and or maybe is it something that just maybe looks good on paper and maybe has some overall vulnerabilities?
That's the way I feel about it. I feel like it's a soft serve ice cream with the sprinkles on top, where the first few bites are really good, and then you're like, what am I actually eating here? And I think if you look and you listen to what big companies are saying, there's small layoffs here and there. Microsoft, several thousand workers here and there, and other industries, especially in tech and in media, are are compressing a little bit. I don't think that we're getting the full picture on what's happening in the labor market. I don't think that the non-farm payrolls report, which is a silly name for it anyway, is telling us much, because it's a survey and so is the unemployment survey, and they're taken in the first half of the month, and so much happens over the course of a 30-day month these days that I don't think we're getting the full picture. I think for the full picture, you got to actually look at the private hiring, the private payrolls, and then you got to look at what companies are saying, or the announcements for forward layoffs through the FAIR Act, where companies have to pre-announce their layoffs and let the Labor Department know. That's where I'm going for the data these days.
It is impossibly somehow already earnings season. I don't know where the time goes, Caleb. I don't know about you. What have we seen so far out of the major banks? Are they bracing for slowdowns in the second half of 2025?
You know, JP Morgan Chase, Jamie Dimon, usually pretty cautious and usually more pessimistic than others, said, you know what, the consumer's holding up actually pretty well here. Could get worse, anything can happen, but when the biggest bank and the biggest CEO of the biggest bank is telling you that, you should listen to that. So bank earnings have been decent, but if you'll also notice, you see this bifurcation. You see it in the stock price differentials between the investment banks, you know, the Goldman Sachs of the world, and the Bank of Americas of the world, or the Wells Fargos of the world, that are more retail, have much more exposure to the retail customer. Banking, M&A, stock trading, all the transactional stuff that happens inside Wall Street is actually doing well for these big banks, and that's, I think, what investors are flocking to. Where's the action right now? It's in actual Wall Street banking versus retail banking, because the mortgage market is still pretty dead right now. We're spending, we continue to spend, but we're not overspending. Delinquencies aren't that high. So investment banking is where the action has been, and in trading because of all the volatility, and that's where you've seen the favoritism. What I want to watch going forward is net interest income, and all the banks tell us about that, because we were all expecting rates to be a little bit lower by now, and maybe they will be by the end of this quarter, we'll see. And when those rates go lower, it compromises their net interest incomes a little bit, and we want to see what kind of an impact that's going to have.
What have we seen so far out of some of the regional banks? I mean, without a doubt, so many of our viewers will remember the sort of regional bank mini crisis we had. It's now going back a couple of years ago. Are they in a fundamentally different camp, given that we are still in a high interest rate environment?
Yeah, different camp, different types of banks, more servicing their regional customers and their community customers, but also by and large pretty healthy. When you look at on their balance sheets and you look at what they're telling us about their customers and their behavior, they're still relatively healthy. No warning signs yet coming out of them. What I'm fascinated with, especially with the regional banks, but also the big banks, is what's happening with stable coins and what's happening with crypto, because all of them are going to get involved one way or the other if these bills pass, and then that becomes a very different type of banking institution. I'm very curious to hear what they're saying about it, and I, just in terms of the classic banking of lending people and businesses money, sounds like it's going okay, but there's not a ton of borrowings, definitely not on the mortgage market, and not a ton going on in terms of enterprise lending at the moment either, but they seem stable.
I'm wondering your take on the major airlines with things with regards to like fuel and labor cost, whether or not they're really eating into airline profits. I feel like maybe we've gotten a bit better guidance than had been previously feared with, I don't know if we're quite at full pre-COVID level of travel, but it seems like the narrative has shifted and we're in a bit more of an optimistic place, Caleb, for the major airlines than we were earlier this year.
Absolutely, and Delta CEO Ed Bastian, they didn't give guidance, if you remember, a few months back, because they could not see the future. Nobody was booking trips way out in advance. Luxury travel seemed like it was going to be depressed a little bit this summer. A lot of the tariff headlines had caused flyers, potential flyers, to pull back on their on making plans to fly, so they didn't give guidance. But when the other day they reinstated the guidance. Now it's not robust, but they are making money where there's money to be made, and that is in luxury travel and the front of the cabin, and they're seeing more booking orders around those areas right now. People are still taking the trip to Positano, you know, they're still going to Portugal, they're still flying, especially on the higher end. What they're not getting is a lot of advanced booking by the back of the plane, the main cabin, because people are unsure if they're going to fly, if they're going to drive, if they're going to take that vacation yet. But the high end's doing fine, and business travel should be coming back as well come the fall.
Does that sort of reinforce the idea of the so-called bifurcated economy in this high interest rate environment? The savers have done better than they have as their money makes money for them. But if you're a borrower under these particular types of pressure points, Caleb, as you know, then you feel the weight of those high interest rates. And we've seen a bit of a divergence between higher income Americans who continue to do a disproportionate percentage of the spending. Is that a fair read to sort of make that equation between that phenomenon and what we've seen, to your point about the airlines?
100%, and you could make that equation and spread it across a bunch of different categories. The high end's doing great. We have more 401k millionaires than ever. If you're invested and you own assets, you are doing just fine right now. But we know less than 50% of the country or more is not really heavily invested in the stock market, doesn't own assets like homes, and so they're not feeling it. All they're feeling is consistent inflation, right? The threat of more inflation potentially coming in the way of tariffs, a job market that might actually be tightening, and having to work a job plus, job and a half, 2 jobs just to make ends meet. So that's just the way our economy is, and it's only going to become more and more that way, especially with the passage of the tax bill.
Yeah, well, speaking of bills passing on Capitol Hill, it was so-called crypto week, not entirely smooth sailing for members of the great deliberative body of the U.S. Congress, but they did make progress on a few key pieces of legislation, things that were really priorities for House and Senate Republicans. Coincides with Bitcoin crossing a new all-time high. It touched about 123 earlier this week. It's pulled back a little bit off those highs. What does that tell you about the overall signal of a shift in market confidence? And I think really something that I know you track very closely, it's kind of this institutional adoption for Bitcoin.
Oh yeah, it's on right now. And Bitcoin's price will tell you that, but if you look across the entire ecosystem of cryptocurrency, it is on like it's never been on. And now you can do things with Bitcoin and some of the major cryptocurrencies you couldn't do a few years ago. You can buy a home with Bitcoin today, right? You can lend and borrow against your crypto holdings with a bank that is happy to give you legal tender in exchange for you to hold on to your Bitcoin for a while. So it's become much more widespread. I think with the passage of some of these acts or some of these executive orders, it's just going to become deeper ingrained into our financial system. So a lot of people don't have any exposure to it, to the coins in terms of their price, but they are going to get exposure to a DeFi, decentralized finance world, entering into the world of traditional finance. It's already happening little bit by bit, but I think this is the year, 2026, is when we see the tokenization of everything and a much more widespread use of crypto and the blockchain in everyday finances.
It's interesting you mentioned the tokenization of everything, Caleb. One of the higher profile IPOs we had recently here at the New York Stock Exchange, of course, is Circle. And I think part of their underlying thesis is you could tokenize many more assets simply than would have already been in the conversation. What do you think is important in terms of the potential tokenization and what it means for retail investors? Something that you think more people should be talking more about or paying a little bit more attention to?
Well, I think it's happening whether or not we want it to happen or not. This is the way the industry's going. So everything will be tokenized. There's already equities that are basically tokenized. You don't own the equity itself, which is antithetical. You own a proxy to it, just like almost like an NFT. So I think that's already happening, and there's already some big price discrepancies between tokenized securities and actual securities. If you look at how Amazon trades as a tokenized security off regular exchanges, there's a big price difference between that and its actual stock price. But I think the tokenization of everything is going to open up trading to a 24/7 sport, just like crypto, right? Because you don't need a market place open from 9:30 to 4 to trade something that's just a token, a representative of something that's just tracking the price. So I think it's going to open up trading. It's probably going to open up a lot more gambling in trading. I think the lines between, sports betting, stock trading, options betting, tokenization, Web3, and crypto are all coming together and blurring together into one big thing. That'll be a theme that carries us for the next decade or so. So I think we as retail investors need to understand what that means, understand the risks of what that actually means, but also the impact when you have a whole nother sort of netherworld of tokenized assets and you have the real world of stocks and bonds and commodities like the one you're sitting in right now at the New York Stock Exchange. Where is that difference? Where's the arbitrage there? And where will I actually do better? And where can I potentially lose a lot of money if I'm not careful?
Yeah, there is a gamification to the zero-dated options game for sure. But with regards to the general crypto hype that we see, especially this BTC rally this week, Caleb, driven more by Wall Street, driven more by Main Street, or a combination of both?
Well, it's always going to be the whales that drive the price of Bitcoin, right? We know that most of it is concentrated in the hands of about 25 or so whales. But if you also listen to some of the biggest banks and financial institutions in the world, they're packing crypto into their treasuries right now. I think BlackRock owns some $78 billion worth of Bitcoin. That'll tell you who actually owns Bitcoin right now. Some of the biggest money managers in the world. Fidelity's been deep into it for years. And we also know that companies like GameStop and of course Strategy have just turned their treasuries into Bitcoin treasuries themselves, and they just rather ride the price up on their balance sheet when Bitcoin rises, and they've been right all along. The scarcity of the asset, in air quotes, of Bitcoin, and the fact that more institutions are grabbing it and adopting it, and the legal framework is being rolled out to where it can now be used in our financial system, that's just going to drive the price higher.
Speaking of driving the price higher, big pop in shares for Nvidia this week. After allowing chip sales through to China. It kind of gets into a little bit of a weedy regulatory issue with regards to the previous administration versus a bit of a new approach from the Trump administration. We know the personal conversations between Jensen Huang and President Trump had something to do with this. And I wonder, when you look at a story like that, Caleb, what does that chip move to China signal either about where the company is, where the technology can be, or really even about just U.S.-China tensions in general?
Yeah, that to me sounds like an olive branch. It's a deal that is being made, part of the negotiation. And when you see more deals like that being made, especially with the biggest company in the world producing the most important components we have in our industrial infrastructure today, really fast GPUs that can process AI for AI and everything else, you know that negotiations are probably getting better. Promises will be made, promises to purchase chips from China, promises to build things here in the US will be made. Proximity to power is so important right now, and we see deals of this nature being struck before we actually have a trade deal. You know a trade deal is likely to follow.
And the Trump White House, very quick to point out a number of U.S.-based deals. Another one in the headlines this week was Apple, $500 million, a rare earth magnet deal with MP Materials. How important is that to where Apple has been, especially as it's kind of jockeying for position a little bit in the AI arms race and kind of getting lost in the shuffle a little bit with the broader Mag 7 names sometimes?
The two most important things beyond national and global security in terms of China-U.S. relations are rare earth materials and minerals, and chips, right? That's where those are the commodities, the most important commodities of the 21st century, and will remain so. So it's a very big deal, but it also might just be a deal in headlines in terms of showing that Apple is coming to the table, working with the administration more favorably to try to strike better deals with China so we can get an actual trade deal done. So it might just be a lot of that, a little headlining on the part of these companies. But at the same time, these are also some of the most important materials we have in our infrastructures today, right? We need those rare earth materials and those rare earth minerals for production of everything we're using, plus the chips. So the fact that these two are in deals with two of the biggest companies in the world, between the U.S. and China, that tells you that things are getting a little bit better in terms of those negotiations.
Caleb, I gotta get your take on what is going on with our man Jay. Not Jay Woods, Jay Powell, the other great Jay of finance down at the central bank. We saw market sell-off this week on reports of the president getting ready to pull the trigger and fire, if he can, the chairman of the central bank, and then rebound minutes later as soon as the president said, quote, "I think it's highly unlikely unless he has to leave for fraud." What do you make of this wild story? And if Powell were to be removed, is there a certain reaction out of not just equities, but the bond yield side of things?
Yeah, I think for sure. I think it's just another, if he were to be removed, it would be another layer of erosion of trust in the government. And I think that would be reflected in probably higher treasury yields and another plunge in the dollar. And that may be by design by this administration, but it would not be welcomed by investors around the world. You want that Fed to be independent. That's the way it's worked since it was set up in 1914. If the executive branch controls monetary policy and interest rates, well, they can do whatever they want in terms of printing more money, lowering interest rates, stimulating the economy, and then when inflation rears its big, bad, ugly head, they'll go and blame somebody else. But the fact of the matter is, the Fed's dual mandate is what has kept this economy prosperous and from running off the rails several times over the last, 100 years or so. And so I'm in favor of an independent Fed. I am in favor of a Fed that is also on the ball and not too late to make moves. But if you look at what's gone on really in the past few years, and you can go all the way back to the great financial crisis, thank God we had an independent Fed. Things could have been a lot worse, and you can blame them for being too late or too early in terms of their timing or not aggressive enough. At the same time, I'm glad they're there with a steady hand on the wheel. If the Fed, if President Trump does fire Fed Chair Powell, it'd be the first time that ever happened in history of the Federal Reserve. It would be pretty unprecedented, and it would be something that I think would scare investors away from U.S. assets.
I think a lot of people are just ready for us to get back to the precedented times. There's so much stuff that's unprecedented week to week. Before I let you go, got to ask you a little bit more about the latest Investopedia survey. Big surprises for you, or things sticking out, especially with where individual investors and the sort of names and sectors and stocks that they're sticking with right now?
So they stick with the big homegrown stocks that they've been riding all along for the past, I don't know, couple of decades, and it looks just like the top of the NASDAQ 100 or the top of the S&P 500 with a couple of outliers here and there. You get an Eli Lilly in there, you get a Berkshire Hathaway in there. So they like what the stocks that brought them here, and then we also ask them, what stocks would you buy and hold today for the next 10 years? Guess what? That looks very similar as well. And you can kind of tell the age range of some of our investors when you look at some of their choices. A lot of older, big dividend stocks in that group of the future 10. But also at the top of the list, Nvidia. At the top of the list of stocks they own today, Nvidia. Is there an overconcentration problem in the stock market? Heck yeah, there is. But you know what? It's not the first time this has happened, and it doesn't mean the stock market's going to collapse. We're just living in the land of the giants right now, but we were in the 1970s with big oil. We were in the 80s with telecom. We were in the 90s with internet stocks. This is just how things cycle through market cycles, and the fact of the matter is the numbers are just bigger right now to where we're talking about $4 trillion companies.
And Caleb, it's fascinating, though, to that last point, you also wrote, as part of the new survey results, more than half of the respondents believe AI and mega-cap technology stocks are in a bubble. Yeah, it doesn't really seem like right now there's much sign of a pullback.
Yeah, and they're like bouncing around in that bubble. They feared a bubble for years with these stocks, and guess what? They just keep going higher. So this is also the fact that we keep buying the same stocks every 2 weeks when we contribute to our 401ks and IRAs or our Roth IRAs. We buy the indexes. When you buy the indexes, you're buying Nvidia, you're buying Meta, you're buying Microsoft, and it's a relentless bid after these stocks. And if you're a fund manager and you got out of these because you were worried about the concentration and you're watching Nvidia rack up another new high and rack up $4 trillion in market cap, and your clients are like, wait, why did you get out of that stock? This is the best stock we've seen in generations. You're going to go back and buy it again. So they may say they're scared of it. They may back away from it. Individual investors may worry about a bubble, but they can worry about that bubble while it continues to bounce higher and up and to the right. And one day it might pop, but for right now, they've been riding some very handsome gains.
I always recommend our viewers, everyone who wants to get smarter in the broader space of finance and the economy, always read every and anything you could find at Investopedia, in particular, those really important retail investor, institutional investor surveys. It's amazing reporting and gives us such crucial context. We always get smarter when we talk with you, the great Caleb Silver, Editor-in-Chief at Investopedia. Caleb, thank you as always.
Thanks for having me. Always good to be with you.